Picture this. Every payday, you promise yourself you're finally going to get serious about money. So you do the responsible thing. You stop impulse spending. You skip unnecessary purchases. You move money into your savings account every single month. $100 here, $250 there, sometimes more. And honestly, it feels good. For the first time in your life, you feel financially disciplined, like you're finally becoming the kind of person who has their life together. But then one night, you're scrolling through your banking app and you notice something. Your savings account has been growing for years, yet somehow your money barely seems to be moving. You did everything right. So why does it still feel like financial freedom is miles away? And then you hear people talking about investing, index funds, compound growth, passive income, retirement accounts. Suddenly, one question hits you. Wait, am I only protecting my money instead of growing it? Because here's the reality most people eventually discover. Saving money creates security, but investing money creates wealth. And in this video, we're going to break down exactly how to transition from saving to investing without feeling confused, reckless, or overwhelmed. If you're someone who's been saving money but still feels stuck financially, hit the subscribe button and let's get into it. Section 1. The big misunderstanding. Here's the mistake most people make. They think saving money and building wealth are the same thing. They're not. Saving money is defensive. Investing money is offensive. One protects your future, the other expands it. Think about it like this. Imagine you leave $10,000 sitting in a savings account, earning 1% interest. After 1 year, you make about $100. Now compare that to investing the same money into something that averages around 8 to 10% annually over long periods. Suddenly, that same money has the potential to grow far faster over time. But the real difference isn't what happens in 1 year, it's what happens over decades. Because time is where investing becomes powerful. A savings account grows slowly, but investments compound. And compounding is basically your money learning how to make money by itself. That's the shift. At some point, you stop working only for money, and your money starts working for you. Section 2. Why people stay stuck in savings. Now, if investing is so powerful, why do most people avoid it? Simple. Emotion. Saving feels predictable, investing feels uncertain. When your money sits in savings, the number rarely changes. It feels stable, safe, controlled. But investing. Some days your portfolio goes up, some days it drops. And emotionally, that can feel terrifying when you're new. Because people don't just fear losing money, they fear uncertainty. This is why a lot of people stay in the saving stage forever. Not because they're lazy, not because they're bad with money, but because psychologically, investing feels uncomfortable. And honestly, that's normal. The goal isn't to eliminate fear. The goal is learning how to invest responsibly despite it. Section 3. Step 1. Build your safety net before you invest anything. You need stability first. That means building an emergency fund. Usually around 3 to 6 months of living expenses. This money stays liquid, it stays accessible, and most importantly, it stays separate from investing. Why? Because emergencies don't care about the stock market. If your car breaks down, if you lose your job, if life suddenly gets expensive, you don't want to be forced to sell investments at the worst possible time. Your emergency fund protects your investments from your real life, and that's one of the smartest financial moves you can make. Section 4. The 2-bucket system. Here's a mental trick that changes everything. Stop thinking about all your money as one giant pile. Instead, create 2 separate buckets. Bucket number 1, safety money. This is your emergency fund, bills, short-term needs, money that must stay stable. Bucket number 2, growth money. This is the money designed to grow over years, not weeks, not months, years. Once you separate money this way, investing becomes much less stressful because now you understand something important. Not every dollar has the same job. Some money protects you. Some money builds your future. Section 5. Start small on purpose. A lot of beginners delay investing because they think they need a huge amount of money. You don't. In fact, starting small is actually smarter psychologically, because the first goal of investing isn't becoming rich overnight. It's building consistency. Even investing $50 or $100 a month matters. Why? Because investing is less about intensity and more about repetition. The people who build wealth long term usually aren't the people making flashy moves. They're the people who keep showing up consistently for years, small amounts, repeated consistently, become powerful over time. Section 6. Keep it simple. This is where beginners often go wrong. They think investing has to be complicated. So they jump straight into day trading, crypto hype, options trading, trying to predict the next big stock. But most long-term wealth isn't built through constant excitement. It's usually built through boring consistency. Simple investments like broad index funds allow you to own small pieces of hundreds of companies at once. Instead of betting everything on one company succeeding, you're betting on the long-term growth of the overall economy. That's a much more stable approach for beginners. And historically, simplicity has beaten complexity for many investors. Section 7. The real superpower is time. Here's where things become incredible. Let's say someone invests $300 every month consistently. Not perfectly, not aggressively, just consistently. Over time, investment growth starts stacking on top of itself, and eventually the growth itself becomes larger than the money being contributed. That's when people realize compounding isn't just helpful, it's transformational. The earlier you start, the less pressure you need later. Time matters more than perfection. That's why waiting for the perfect moment to invest often becomes expensive, because the perfect moment usually never comes. Section 8. What about market crashes? Now let's address the fear everyone has. What if the market crashes? First, it probably will, at some point. Markets go up, markets go down. That's normal. But here's what experienced investors understand. Market drops are temporary. Long-term discipline is permanent. In fact, when markets fall, consistent investors are often buying investments at lower prices, which can actually help long-term growth later. The biggest mistake beginners make is reacting emotionally. They panic, they sell, they quit. But wealth is usually built by people who stay patient while everyone else is emotional. So here's the real path from saving to investing. First, build your emergency fund. Second, separate safety money from growth money. Third, start investing small amounts consistently. Fourth, keep your strategy simple. And fifth, give compounding enough time to work. Because at the end of the day, saving money gives you peace of mind, but investing gives you the opportunity to build freedom. And the moment your money starts growing faster than you're contributing to it, that's when your financial life truly begins to change. If this video helped you better understand the transition from saving to investing, subscribe for more videos on building smarter financial habits. And let me ask you something. Right now, are you still in the saving stage, or have you already started investing? Drop your answer in the comments.